What is U.S. Social Security tax? Old age, survivors, and disability insurance tax. The United States Social Security tax, officially known as the Old Age, Survivors, and Disability Insurance Tax, is a mandatory federal payroll tax that funds the nation's primary social insurance program. Established under the Federal Insurance Contributions Act, this tax is designed to provide a continuous stream of income to retired workers, their survivors, and individuals with disabilities. Both employees and employers contribute to this system, ensuring that the burden of funding is shared across the labor market. For most workers, these deductions are taken automatically from their gross pay and reported on their annual filings. The revenue collected is held in the Social Security trust funds, which are managed by the Department of the Treasury to pay out current benefits and ensure future solvency. The calculation of Social Security tax is based on a fixed percentage of an employee's gross wages, up to a specific annual limit. Currently, the tax rate for employees is 6.2%, which is matched by an additional 6.2% from the employer, totaling a 12.4% contribution for each worker. However, this tax only applies to income up to the Social Security wage base, a threshold that is adjusted annually to account for inflation and changes in national average wages. Any earnings exceeding this cap are not subject to the Old Age, Survivors, and Disability Insurance tax, although they are subject to Medicare taxes. For self-employed individuals, the responsibility is higher as they must pay both the employer and employee portions, totaling 12.4% through the Self-Employment Contributions Act. The funds generated by these taxes are not stored in personal accounts for individual taxpayers, but are instead used to pay current beneficiaries under a pay-as-you-go system. When a worker pays their Social Security taxes, they earn credits toward their future eligibility for benefits, with a maximum of 4 credits available per year. Most workers need 40 credits, typically representing 10 years of work, to become fully insured for retirement benefits. The amount of the eventual monthly benefit is determined by the worker's highest 35 years of indexed earnings, meaning those who pay more into the system over time generally receive higher payments. This structure creates a direct link between a lifetime of tax contributions and the level of financial security provided during retirement. Compliance with Social Security tax regulations is strictly enforced by the Internal Revenue Service and the Social Security Administration. Employers are legally required to withhold the correct amount from employee paychecks and remit those funds to the federal government on a regular schedule. Failure to properly withhold or pay these taxes can result in significant financial penalties, interest charges, and potential legal action against the business. For employees, it is crucial to monitor their annual Social Security statement to ensure their earnings are being recorded accurately, as discrepancies can lead to reduced benefits in the future. As the American demographic shifts toward an older population, the management and sustainability of these tax revenues remain a central topic of federal economic policy and legislative debate. We welcome you to subscribe to our YouTube channel for more informative videos on taxes, finances, and investments. Thank you.